present.
Left. Thank you, Keith. Okay, I'll try not to page turn too much, but I think if I just follow through the presentation so that you can all follow me. Okay, good evening, everyone. I'm James Robson. I'm the Chief Investment Officer at RM Funds. As Keith mentioned, we're going to talk about RM Secured Direct Lending, which is one of the strategies that we manage at RM. Really, RM Secured Direct Lending is a non-bank lender. So we're focused on making loans to three sort of categories of loans. The first would be to middle market corporates. The second would be to project finance, so specific assets such as real estate. And the third would be asset finance, sort of pools of assets. We really focus on capital preservation and income for investors. This is, a bit of a tortoise and the snail, and I'll come on to that. And we're very much the snail. Our focus is to deliver a steady income of 6.5 pence per share per annum. And we've generated that in 2016, which is actually 4.2 pence, but that was our first year of ramp up. 2017, we achieved 6.5 pence. 2018, our last year, we achieved just over 7 pence. And for this year, we'll be targeting the 6.5% run rate. We've had a stable net asset value. So the assets of the company when we launched in 2016 was 98. And at the end of last month, it was 98.31. Unfortunately for us, I would say that the share price is not necessarily reflective of that. And obviously, the share price trades around the net asset value. Traditionally, we've traded at a premium. I think this investment trust is very highly regarded by our peers and just generally by the market. But unfortunately, just given recent events, we have started to trade at a discount. So if we look at our 6.5% run rate and the current share price today closed at about 90, to my mind, that would imply an over 8% running yield, if I look at this from a debt perspective. I'm pretty much aligned with our investors. We own as a business 1.1 million shares. I think that's a typo. I think it's 1.2 million now. I own, I think, 300,000 shares myself, and the broader management team do the same. So I think we've tried to align ourselves very much with the investors, which I think is relatively unusual in this day and age. Okay, I've got the hang of it now. So, RM Funds, who are we? So we are a specialist alternative asset manager. We set up in 2010. Our credibility, if you like, is that we've arranged and advised on over £1.5 billion worth of alternative finance transactions since inception. We set up our first private credit vehicle in 2015. We launched the investment trust RM Secured in 2016. And now we also manage an open-ended strategy, which again is focused on the alternative sector called the VTRM Alternative Income Fund. I think that our track record stands for itself. We are, when I Googled it earlier, we're number 2 out of 130 in Citywire for the Alternative Income Fund. And the RMDL track record speaks for itself. Unfortunately, as I say, I don't think the share price is probably reflective of the performance, but that's a 3-year track record of really delivering for our investors. So, senior management team, as I say, I'm the Chief Investment Officer. Pietro Nichols co-manages the investment trust with me. And you'll see that we've got a deep management team. The head office is in Edinburgh. And we have our London office just off Liverpool Street. So, now to the interesting bit, current market conditions. And I obviously wrote this slide and sent it to the Hardman team before the excitement of the last sort of 48 hours really kicked off. What does this show us? So this graph here, the purple line is the crossover index. And for those that are familiar with it, or those rather that are unfamiliar with it, that's the spread of the 50 most liquid high-yield names trading in credit derivatives in Europe. Okay? So The spread starts off in 2011 at 800 over, and it comes into here, Jan 2020, at just over 200, and it starts to widen out to about 300. It actually gapped out 24 hours ago to 500. But broadly, what we're saying here is that spreads are at record tight. Record tight. Investor protections are also very weak. So it's a lender's market. It has been a lender's market for the last 5 years. So what that means is your covenants on transactions are light or they're non-existent. You're structurally subordinated. You're in all sorts of funny places of the capital structure, which potentially as an investor, if you're lending money to people you don't want to be. So it's a curious position if you landed from outer space, because you would land here and you would say, I'm being compensated, the least that I've been compensated since the global financial crisis, and I'm taking the most amount of exposure. And on top of that, if you put in what's happened with rates products and duration risk, you're also taking an enormous amount of rates exposure as well. And there's I digress, but if you want to Google the Austrian 100-year bond and look at the price movements of that, you can see the effect that duration has, especially on these long-dated instruments, and it's clearly very dramatic. So I think these are things that we don't really like in credit. At RM, when we look at this cocktail, we don't think that's very compelling to invest in corporate credit under those terms. And actually, if you look at that little gold line along the sort of top there, that's the average yield within our portfolio. Okay. So what do we offer at RM? What's our sort of secret sauce? I think we're really trying to give investors access to an illiquid asset class. We're doing this in the right vehicle. We've all seen post-Woodford what happens if you put illiquid assets in an open-ended structure. So the structure is absolutely bang on. Okay, we're making illiquid loans, and it's in a closed-ended vehicle. We, as a manager, have a proven ability of sourcing these transactions. Okay, 60% of this portfolio is self-originated. 60%. So you can't get exposure to that through any other portfolio. 60% of the deals in this portfolio, we've originated the transactions, we've agreed the terms with the borrower, we've documented these deals, and we've effectively funded the deals, and we monitor and control those. 40% of the deals are transactions that we cannot have the capacity to deal with. They're too big for us, and we want to be part of a broader lending syndicate, and they're businesses that are very large. They're the kind of businesses we want to invest in as well. So from our perspective, we're offering investors something that they can't get anywhere else in our minds. From the investor's perspective, within the portfolio, there are robust investor protections. So we have covenants, we have security, and the assets are well collateralized. So my bottom point there is really, what are we trying to achieve? We're trying to achieve the capturing of that illiquidity premium and the complexity premium. These deals can be complex to understand, they can be complex to structure, or they can be complex to analyze, and that's what my team at RM do. The approach to lending, I mean, this is pretty dry, and I'm not going to go through it, but I think what you'll see here is that there's a well-structured and well-thought-out process to how we deploy capital. The most important thing here is that all of the transactions in this portfolio, we undertake our own internal in-house due diligence. So whether we're structuring our own deal or whether we're reviewing someone else's docs, we take responsibility for that in-house. We do our own credit work. We're credit people. That's our background. We have ESG criteria in here as well. It's actually not in the wagon wheel, but as we are all aware, that's becoming increasingly demanded by investors, and the second largest investor in this company is the CCLA. Okay, so getting on to the interesting thing, the governance. So we've got a strong board. Norman, our chairman, is sat at the back with his hand up, if anyone would like to bend his ear later. The valuation agent. So this is, the devil is in the detail. The devil is in the detail. When you're investing in a private credit investment trust, make sure they have an external valuation agent, because ultimately this valuation agent is responsible for the asset value of the portfolio. There's an embedded conflict of interest if I'm marking our own portfolio. Okay, that sounds very obvious, and it is, but it's something that many people miss. So when we review the net asset value of our business or of the investment trust, that net asset value is something that can stand up on its own 2 feet. And then the other point is the accounting policies. So again, this is a very small, very detailed point, but I believe that marking to fair value is the appropriate accounting policy for this type of investment trust. And what that means simply is that on a monthly basis, the investments are marked to where there are discernible prices. And if there are no discernible prices, if anything surrounding those loans have changed, then in terms of perceived or actual risks, then the prices will move to reflect that. So on a monthly basis, when we release our NAV, you see the mark-to-market moving throughout the portfolio. It's not just a linear progression, and then you have a problem, and then there's a downdraft. It moves. It's constantly changing. Okay. So just a quick slide on our NAV, and this is really the hare and the tortoise. And it's a pity I didn't do this slide a week later, because it would have been a bit more flattering in terms of our performance. But you'll see it's just a very steady progression upwards to the right. And I wouldn't really expect anything less. If you look at the bottom sort of bar chart, you'll see the actual monthly NAVs, and they move around. So this isn't some sort of fictional expected loss that's put in a model and I've hit Shift F9. There's actual monthly marks that are going within the portfolio. It generates a net interest income, which, as Keith rightly said, is 8.5% or 8.55% gross yield. Take off your monthly running cost, take off your loan losses or your marks to market, and you get your net NAV. So maybe I'll just dive into the portfolio. So this was at the end of last year. There's 134 million of investments. I think there's 34 line items. Our focus really is on lending to businesses with tangible asset backing. I mean, it's a relatively straightforward concept. You know, to that end, our focus has been on the social infrastructure space. So we call it cradle to grave. We've had a real focus on lending to childcare nurseries. We've had investments within student accommodation. We've got some decent exposures to aged care and care homes. We also look to lend to real estate assets such as hotels. We have pools of asset finance that I spoke about earlier. So, for instance, Pratura Asset Finance in Manchester. We fund a portfolio of over 1,000 diggers and pieces of heavy equipment. So it's a very, very diverse pool of loans. I've tried to break down the sort of the metric of leverage, which we technically look at it in a number of different ways, and we can look at that cash flow or loan to value, but I think most people really like it distilled in a loan to value metric. So the portfolio value, 61 to 75% of the loans have, 54% of the portfolio has a loan to value of 61 to 75%. That's the sort of sweet spot for us. That's the area that we're operating in. If we look along the bottom wagon wheels, what it's saying here is that 59% of our borrowers are sponsor-backed. So effectively, they're private equity-backed. Now, that comes with its own challenges, because private equity typically wants to put as much leverage as possible into a business. But also, they have capital, they have structures, they have good management processes. So we do like private equity. So we like working with borrowers who are sponsor-backed. Half the portfolio is senior secured, and the rest is junior secured. And there's another couple of metrics there. But broadly, half the portfolio is senior, the other half of the portfolio is junior. The way that we split the book down is to looking at half the portfolio is within corporates, and the other portion of that is sort of effectively project finance or asset finance. And finally, half the portfolio roughly is fixed and half is floating. So the duration is very modest. We have a number of limits within the portfolio to ensure that there's appropriate diversity. We don't want too much borrower exposure. Should things go wrong, we need to make sure that the portfolio is well diversified. We have that specifically as 10% of gross assets. At the moment, I think we have 2 loans that are, let's say, 8% of gross assets. But broadly, the idea is to have the portfolio as broken down as possible. And that's the wagon wheel there. Relatively unexciting, I would say. So I think that's me. I have hopefully given you a good flavour of what we do. I'm not sure how much time that took up. There's room for some questions. So I've been speaking at you. Would anyone like to ask me any specific questions?
You've got a quarter of the portfolio exposed to the hotel sector. Mm-hmm. Does that concern you in the current coronavirus?
Yeah, it's a good question. So, yeah, it's sleep at night stuff that we invest in, but 100%. There's very few areas of your portfolio, in any portfolio, I think, that isn't going to have some sort of headwind when it comes to the coronavirus. And when we look at student accommodation, who knows what students are going to be coming to the UK or taking up residence. But we thought of that as a very defensive sector. When we look at forecourt operators, people we always thought would be trucking and rolling around the country and buying sandwiches and fuel. And the same goes with hotels. I think with hotels, our focus is mid-market branded hotels. So hotels such as Hampton by Hilton, 3-star, maybe 4-star. I think what gives us the comfort to sleep at night is 2 things. One is the borrower equity. So we're not taking equity exposure here. We're lending money to the hotel, the hotel owner, the real estate owner, not the hotel operator. So there's borrower equity, the sponsor equity. So ultimately, there's capacity there to absorb shocks. And the second is the covenants within the transactions. And I touched upon those very briefly. But the transactions that we document have lender covenants, something that I said was very absent within the broader market earlier on. So should a downside scenario, we look at base case, downside, and disaster. We're lenders. We're not equity upsiders. That's not for us. So should the downside materialize and not the base case, we then have covenants to protect us. And just to give you an idea of what those covenants would be, it would be simple metrics like an interest cover covenant. So ultimately, if the trading performance of the hotel deteriorates, then the cash flow from that hotel starts to get locked up within our structure, and that deleverages it. Okay, so we feel that we're earning high-quality risk-adjusted returns, and I think the average yield on that on the hotel book is about 9%. So we're ultimately lending to branded mid-market operators and receiving 9% with equity subordination. So I think that's how we mitigate it. But yeah, absolutely, we don't quite know where this is going to end up.
What is your bad debt experience?
Okay, so that's another good question. So I don't look at it really in bad debt terms, insofar as we only have 34 investments within the portfolio. Okay, we mark to market the portfolio. So ultimately, the expected loss, if you like, is within the mark. And if we look through the fact sheets, you can see that happens on a monthly basis. So I left some presentations around the room at the back with our monthly fact sheets on it. And on those monthly fact sheets, you can see the net interest income that gets generated by the portfolio. You can see the net return per month, and the difference is clearly the loss rate. And that loss isn't a write-off as such. It's just marks that we put into the book on the basis that there might be a downside situation occurring here, or the price, a third of the portfolio, as I mentioned earlier, I might not have mentioned it, is priced externally. So there's potential visibility in the market through the investments that we're in. So they're marked externally via a company called Mark IT on the bid side. So that company might be performing fine. If we look at Elysium Healthcare, is a healthcare business that we invest in, and I think the Mark IT mark for those last month was 93. So that, you know, Elysium is performing, but there's a 7% markdown, if you like, within that part of the portfolio, just by virtue of where the actual or perceived risks are in the market. So it's not a write-off, if you like. Does that make sense? Have I explained that in a very complicated way? Yeah, I mean, we do a very good job in recovery, to be honest. It's, you know, we do base case downside and disaster, and we plan for the worst. So, as you say, money that goes down the drain, we haven't had yet, but we mark appropriately. So when you're in a downside situation, you move the mark lower. So the key point for you as an investor is you don't have a sudden announcement saying that the net asset value has gone down by 10%. You see it in the mark every month.
I just wanted to ask, you know, the structure of the investment trust is very complex to understand for the retail investor.
Mm-hmm.
And I'm just wondering about the retail investors that, I don't know, come to your AGM, let's say, or whatever. I mean, you know, what's the age bracket, or what kind of investor are actually?
Most of the investments in this investment trust, I think, are institutional investors. I think there's a very, very big tail of investors. So I think there's about 50 institutions in there at the moment, and I don't know how many retail investors there are. I think what we've done is, and again, is that within our space, disclosure is very weak. When I say our space, I mean debt investment trusts. If you look at the debt investment trusts that would be considered our peer group, I think the disclosure is relatively poor, unfortunately. And you're right, the structure is possibly hard to understand when you can't actually see the underlying investments, or you have no visibility over what's going on. So our view is that it's the investors that own, obviously, the company, and therefore they have a right to understand what's going on, and therefore no one has any surprises. So our disclosures are very good, and we distribute our monthly fact sheets on our website every month on the 16th of the month, or the following Monday.
As a borrower, why should I approach you for money rather than go to a bank?
It's a great question. I mean, if you're a guy called Ian Robinson from Satcom, who's in the Northeast, I'll give you a good example. So he came to us in 2015, and he needed money to fund marine satellite communications on a ship. Okay, and RBS said to him, "We don't do marine." He said, "Well, it's not marine. It's a piece of equipment. It's floating around, but you're not getting marine exposure." And if you look at that marine that satellite communication equipment, it's like a spark plug in a car. So we looked at that as digital infrastructure. You know, we didn't look at that as shipping. That's digital infrastructure. If that radio isn't turned on, that ship can't sail. Okay, so the phone bill is very modest. You're talking super tankers. So we said to Ian, "Well, that's digital infrastructure. We'll set this up as a project finance transaction. One of the 3 pillars that we look at. We'll put the assets within an SPV. We'll control that SPV. We'll have lender control accounts within that SPV, and we'll have a servicer set up so that if Satcom fell away, we could still get it serviced. And we would do a proper technical due diligence on the equipment." So Ian, we gave him a $10 million funding facility. We did 54 drawdowns for him over 4 years, and they were refinanced by a bank, because now it's bankable, in December. So we typically, our borrowers get to a point where they then get, you know, access to the Barclays Bank corporate team who want to do a £50 million deal with them. So the sort of the 60% of the portfolio where they're bilateral deals, it's those types of borrowers. So we're really providing, you know, borrower-led solutions. People come to us with problems. 95% of the transactions we see, we're not interested in because they're in the wrong sector for us. The deal doesn't stack up. The sponsor is weak. The pricing isn't right. The covenants don't work. All sorts of reasons. The assets are poor. But then there's the odd one that, there's an opportunity there for us and the borrower to get a mutually beneficial outcome. Possibly, but I think there's a, the paradigm from the alt-fi space is that people said there was a new paradigm, that the non-bank lending space arrived because there was, the customers weren't being serviced by banks, and actually, I think what we're finding out is that a lot of these alternative lenders have sprung up, lent money to people that should never have been lent money in the first place. So absolutely, we need to screen those people out. But there's a contingent of them, Protura Asset Finance, I just mentioned, from Manchester, where we can work with them. Now, other borrowers are very big. We invest in Mehiläinen, and it's a Finnish healthcare business. The sponsor put in €1 billion of cash, and we're in the loan. So we're dealing with some very, very big sponsors and some very, very modest sponsors.